Okay, so we have the recording here in case anybody wants to review it. And like I said, we will look at NVIDIA. I'm not going to put out a signal without running this by Scott, not because he told me not to, but because he's the one that eventually is going to have to deal with it. So, if we come up with something, I will certainly run it by him. But this is in no way a signal. The signal will go out as it normally would. Okay, so we're looking at NVIDIA. So the way that this is largely the way that I approach earnings plays. The first natural thing to do would be to look at the chart. So we have the chart here in NVIDIA. Here is let's get like about a year. Let's 6 months. Okay, so we've seen that since last earnings, it has basically been very, very range bound between here up at, let's just call it 175, and here down at 125 generically. So I mean that's a big range, but it's a $25 range on a $170 stock, $150 stock, excuse me. So it's right in the middle of that range right now, trading about 150, 155, somewhere in that range. Now, looking at the chart, you should look at it, but remember that the typical way that we deal with technical trades don't really hold with earnings. Why? Because anything that materially comes out that is much different than where the price is now reflecting doesn't care about where support and resistance is. I jokingly make the thing that if NVIDIA comes out and says, you know what, we've been cooking our books for the last decade and we've never made a cent, that stock is going to zero and nobody cares where the 200-day moving average is or where support and resistance is. Why? Because something materially has changed about the stock. Okay, so so it's something to consider that if there's this crazy, obvious trend, it's something that you're going to probably want to take heed of. That doesn't mean that you just, it's obviously in a bullish trend, so obviously we should put out a bullish signal. That's not necessarily the case. But it's one thing that we look at. So what do we find out from that chart? That chart is just telling me it's been range bound. It's waiting for the next piece of news. Okay, so the next thing, and really the only thing that we can look at now, there's a lot of services out there that like to try and predict where EPS and revenue are going to come in. You can pay a lot of money for that. The thing is that really doesn't tell me much, because we could beat both numbers and the stock could go down. Why? Because the market was expecting better than that. That's so just beating numbers and trying to forecast where EPS and revenue comes in isn't very helpful either. It's not very predictive. Now, of course, if it way outperforms one way or the other, or underperforms, well, then that may be, but who knows? And we can't be in the business of trying to predict outliers. So one thing is to consider, okay, what has the market been doing in general? The market's been doing pretty okay. It's been grinding up, and tech has been okay. So in the space, you could argue is it got beat up for part of this last quarter, but it's made its pullback. For me, one of the biggest predictors is how is this done over time on earnings. There are some stocks that perform well on earnings and some that underperform on earnings. Why? I don't know, and I really don't care. But it's one of the things that we can look at. And so in here, we can go to Windows, and we can go to Earnings and Divs. And we can look at this. We can say, it's one of the nice things about this program is that it has a very good database of implied volatilities and earnings. So we can look at the last 8, typically is what comes in here. And we can see how it's done. Is there a pattern there? Sometimes there is, sometimes there isn't. Okay, so we see going back to February of 2017 that it went down on earnings here, it went up on earnings there, so we're 1 and 1. Here, well, we're 1 and 2, we're 1 and 3, so 2017 wasn't great. 2018 a bit better, so we were 1 and 3, now we're 2 and 3. This is kind of down, kind of unchanged. Let's go 2, 3 and 1, down, 2, 4 and 1, and down, 2, 5 and 1. So if anything, earnings haven't been a great thing. Now you can see that even when it went down, it was a pretty good place. Well, oftentimes it was a good place to scoop up some stuff. But on earnings itself, if we're just playing it for earnings, it hasn't performed great. So just an outright directional upside play doesn't seem like it would want to, like what I would want to do. So what am I thinking? I'm thinking neutral to downside. Obvious to me is that I would want something delta neutral if I can, if it gives me the right reward to risk. Why? Because it's been, earnings in general, directional wise, you can argue that it's been a crapshoot or it's slightly negative. But if I don't have to pick a lane directionally, why would I pick it? I wouldn't. So let's look here. First off, we have to find, I think he has this up here. Pardon me. As probably everybody is battling. I'm looking to see if we have the tool in here. I know it's in the I believe it's in the documents tab if I remember correctly. Let's see if I can get it from there. All right, here we go. Sorry, that took a couple seconds here. All right, there's that tool. And we can figure out what, make this a little bit smaller, what we're looking at here. Okay, so for NVIDIA, remember we need 3 pieces of information. We're trading 154.77. We want to go out to just this Friday, because that's the move we're concerned with. And that implied volatility is 118.22. So we are pricing in approximately, if we go out to a full standard deviation, that's like 8.75%. If we want to be a little bit less aggressive, 7.75%. So somewhere in the neighborhood of high 7s, low 8s would be a conservative place to target, which to the upside is probably around 166, and to the downside is probably like 143 or something like that. So if we can, let's see, to the downside, let's target 143. And to the upside, let's target 160. Well, we have to go 165 or 167.5. We'll go 167.5. So the 43.67.5. Here's the 43s here, going out just 1 week, and then the 67.5s here. Okay, so this is what this is going to look like. Right now, that strangle swap is trading about $1.70. Now we have to figure out, okay, we got that. We know what the risk looks like for something like this. So we know what this is going to look like, but we have not changed what the vols look like. So if we're going to go out to, let's go out to tomorrow's date, it's going to look like this. But we know that implied vol is not going to stay here. So now how do we look at that? Well, again, what do we have to go by? We have, let's just look at the last 6 months. We'll get rid of the historical vol here because that's no use to us. So this is what vol has done. Going into earnings here, we've seen that, let's just be generic here. This is where they take vol to. They take vol to about 48%. So if they take vol to 48% and we want to go backwards, so if they go 48% here at the money, excuse me, wrong column, 48% here, we have a little bit of negative call skew, so I'm going to go, is that right, 48? 43%, excuse me, 43%. 43%. This is going to, let's just say that we're going to, a little bit of negative call skew, and then there's probably going to be some put skews that's still in that. So let's go 2 vols higher than that, take that to 45 there. Well, we took implied vol down in the place that we are long. Well, we have to take this down. Now, most likely this vol will come down to be even with the back. But in an effort to be conservative, instead of taking this to 45, let's take this to 50. And then leaving that same call skew here, there's what? Difference between here is 3. So 50 and 47. That's going to really knock down that front month because there's really not going to be anything to it. You know, we could take it to 60, and when you're talking about just that's probably not enough. Well, no, that's probably okay. We got about 20 cents left in this. So now what's this? Well, we still know that this is going to be trading for $1.70 or so. And then what does this look like? Well, it's going to be drastically different. But go to tomorrow's date. So what we need is push the date out to tomorrow. So what you can see is that we need a much bigger range here. But there is a place where we can make a little bit of money. But most places we lose money. And that's what's difficult about the strangle swap. Oftentimes it doesn't provide the reward to risk. So now you have to ask yourself, okay, do I like the calendar? Yeah, kind of. Do I like the put side or the call side? And that's where we have to, that's where Scott and I are going to have to talk. So if we just do the put side, because I don't see not that it can't go up tomorrow, but I don't see anything that's pointing me that way. So now this is going to be trading for about 60 cents. Excuse me, no, it's not 60 cents, it's 85 cents. 85 cents, and we can just about double our money if we get that 8% move. Do we want to make that play? It's not the worst thing in the world, but like I said, it's something that I'm going to have to talk to Scott about. Okay, so that's just a quick run through on how I would analyze something. The disclaimer being that the opinions put out here by Mike Shorr are not necessarily those that are shared by Scott Bauer, and he has the right of refusal on any of this. But that's that. So I did record this. I'm going to render this, and then perhaps we have something coming out later, but nothing right now. Thanks a lot, everybody.